Good afternoon and good evening and good morning to the folks out there. Thanks for joining us. We're just waiting on a few more people to come in. We've got quite a few people joining us today from many different countries. Most importantly, joined by the beautiful lady on my left, Lisa from ABCD, Australian Business Council, who we're co-presenting with tonight. I'll let Lisa do a bit of introduction on who she is and who the ABCD is, just while we've got a few more people coming online.
Perfect. Thanks so much, Brett. And then I can actually introduce you as well. So yes, I'm Lisa. Most of you, or some of you might know me, some of you might not. I'm the manager of the Australian Business Council, which we affectionately call the ABC, based here in Dubai. We are a non-for-profit membership-based organisation, and we work really hard to support Australians in the UAE, in region, and the community as well. So. And part of what we do is provide events that we think would be of value to the Australian expat community. And one of which is an event like tonight, which is a briefing on the Australian economy with the end of financial year upon us, and what a bumpy year it was. So as we sort of said in some of our marketing brief, we've had, COVID lockdowns, which Australia had the worst of, I think, in the last sort of 12 months particularly, a federal election, and then a 50 basis point interest rate hike. So it's all fun and games happening down under. So thank heavens it's not down to me to crunch the numbers. We're joined by the fabulous Brett Evans, who's the Managing Director of EMEA and region for Atlas Wealth Management. So I think we just had a webinar interrupt us. But without further ado, I will turn my camera off, and I will mute myself, and I will hand over to Brett as he makes sense of all the facts and figures for the Australian economy. Over to you.
Fantastic. Thanks, Lisa. Okay, guys. Well, I think we've got the bulk of everyone joining us now. So just doing a quick check here. Bit of housekeeping issues for those who are watching. Obviously, everyone's watching. Can you just let me know, can you see the PowerPoint presentation on the screen and or my camera? Some people are on iPad, some people are on iPhone, some people are on desktops. So just in the questions box there, just let us know whether you can see something on the screen apart from my head, which apparently is good ahead for radio. Okay, answers are coming through there. Yep. Fantastic, guys. Okay, so just a couple of housekeeping issues too. As part of this session, we're going to run our Q&A session at the end, which people always find interesting about. And yes, what we're going to find is, going through the economy, as Lisa touched on. At the end, I'm going to also provide a bit of an update on the non-residency rule changes as well too. So get your questions ready. As I'm talking, just start typing in the questions box, because that way we can run through those at the end of the session. We're going to run through to about 7:30 tonight for those people in the Middle East region. We know you've got dinner to go to, so we're not going to hold you up from that. For those in the Europe and UK region, we'll try and get you finished before dinner. And for those in the United States, we'll get you breakfast ready. So without further ado, let's get the show on the road here. Okay, so no presentation from us would be replete without a disclaimer. And essentially what this information says is that the information you're about to hear today should be used for entertainment and informational purposes only. Please do not construe this as financial advice. We are going to try and give you as much information as possible from a usefulness point of view, but obviously any information that you need to seek personal advice on, please speak to a professional who is properly licensed, like ourselves at Atlas. At the end of the day, this information we'll try and touch on, certainly in the Q&A section at the end. We'll try and answer your questions as completely as possible, but if they do border on personal advice, then we may have to sort of just highlight that and answer it in a abridged way. Atlas Wealth Management, I'm based here in the Dubai office of Atlas, as Lisa said. I look after the EMEA region, so Europe, Middle East and Africa. Atlas has two offices. We have one office in Dubai that covers this region. We have another office in Australia that covers the Asia and the Americas region. This office here is dual licensed both with the Dubai Financial Service Authority in the DIFC in Dubai, and we're also a corporate authorised representative of our parent office back in Australia, which is licensed by the Australian Securities Investment Commission. Who is Atlas Wealth Management? We're the leading provider of Australian expat tax financial advice, and we've won many awards for this services. We've been doing this for, I think it's coming up on 12 years now, so not our first rodeo, and we've seen a lot of change going through. We're classified as a tax financial advisor with the Tax Practitioners Board back in Australia. We have clients now in almost 45 countries, so we need to update those slides. It's amazing where you'll find expats squirreled through the four corners of the planet of ours. All of our financial planners are degree qualified with actual financial planning degrees, not some other things that other people will have, with numerous postgraduate certifications. These two guys here, that's myself on the left, just for those who don't know what I look like. And on the right there's my colleague James Ridley, who is the Managing Director for the APAC office. So he looks after the Australian office and looks after clients in the Asia and America region. On to the agenda for today. So we're going to touch on the world economy and how it's looking and what's going on there. Then we'll focus our attention on the Australian economy in particular and sort of talk through a couple of key points. Then we'll discuss what's happening in the equity markets, the currency markets, the property markets, and then at the end we'll hold that Q&A section. So don't forget, if you do think of questions as I'm talking through this presentation, feel free to start queuing up those questions so we can get straight into that and make the most useful time of, make the most of your time. So let's get on to the world economy. Now, obviously, where do we start here? There's a lot going on, and any one particular event we're going through right now would be considered a macro event, whether it's an invasion of a country by another country with Russia and the Ukraine, whether it's a COVID pandemic, whether it's inflationary issues. The fact that we're dealing with all of this at the same time means there's a lot to chew off, so a lot to bite off and chew. So what we're going to do is run through what's causing the consternation in the economy, which in this case we've got supply chain problems that were hangovers from when COVID first started. Obviously Russia invading the Ukraine. It's amazing when you do look at the Ukraine, even though you wouldn't think they are a big part of the global economy, they do have quite a large effect in terms of some specific areas. For example, the Ukraine exports 30% of the world's wheat supplies. That's why we're seeing problems in supply of wheat. Believe it or not, Ukraine is a large manufacturer of wiring looms for cars. So when car manufacturers are building their cars, they have these wiring looms which connect all the wires together to make the headlights turn on and off, the indicators go, the airbags and sensors. A lot of those are actually built out of the Ukraine. So we are seeing problems with that, but also that's convoluted by the situation of energy prices, obviously with what's happening with respect to Russia, and also to the relatively high energy prices that were in the lead up to the invasion of Ukraine by Russia. Another cause is the excess capital and liquidity injected into the economy by the central banks. The central banks are synonymous with almost overshooting when it comes to how much stimulus that the economy needs. And we saw that through the GFC when the US Fed should have started tapering their quantitative easing in 2011. They left that until 2014, and then we had that big bull run that occurred after that. And we've seen a similar situation play out over the last 12 to 24 months. Biggest thing for us looking at what's going on right now, we are seeing we're almost paying the price of the central banks around the world being very slow to act. Blind Freddy could have seen inflation was creeping at an alarming rate last year. Financial markets were talking about and almost calling out the central banks to start raising rates. We saw back in October, financial markets were calling out to Philip Lowe, who's the Reserve Bank governor back in Australia. And at that time, Philip Lowe was still saying, no, we're not going to raise rates until 2024. The markets were saying, yes, you have to, based on all of these inflationary triggers we're starting to see. And then here we are 6 months later, and we only just started to see the central bank starting to raise rates in earnest. And that slow reaction is almost like the horse is bolted, have a cup of tea, and then now we're starting to chase it. So as you can see in the next chart here, this is essentially inflation figures coming out through United States, the Eurozone, United Kingdom, Canada, Japan, and Australia. And we saw UK's numbers come out today at 9.1%, which is a 40-year high, which is massive. So even though the Bank of England was relatively early when it comes to all the central bank responses, they rose rates last year, it's obviously a little bit too little too late. And what we're starting to see now is central banks instead of tapping the brakes, they're almost getting 2 feet and jumping on those brakes to try and really slow those economies down. What we don't want to happen is we do not want to see the world economy go through what we call stagflation. Stagflation is when you have inflation in the background with no economic growth. So they've got to try and find that balance between a rate of growth in GDP of about 3 to 4%, but trying to bring that inflation down. So when it comes to the respective central banks in each of the different countries, as you can see here, we're having quite a different dramatic effect between the United States, the UK, and Europe. They're all very similar. And then you have Canada, Japan. Japan's, well, we won't discuss that one because right now I don't think that's as big an issue as it is for the Eurozone and the United States. But certainly Canada is going through a very similar scenario to Australia because it is a very similar economy in terms of its makeup of its GDP. So what we've seen recently is the US Fed hiked their interest rates by 75 basis points last week. Their dot plot. So their dot plot, what a dot plot is, you know, when you see a line in the chart and then the line is solid, but then the forecast is where the dots go. So their dot plot is expecting hike signals of another 75 basis points in July, 50 basis points in September, and then 225 basis points move towards the end of the year at 3.4% for the official cash rate. So 3 months ago, this figure's at 1.9, so quite a dramatic change. Now what we see is the central bank governors trying to use maybe 2 tools in their arsenal. The first tool would have to be obviously monetary policy, which is what we're seeing right now, raising and lowering rates and injecting or tightening up the supply of capital into the market. But we also see them using the press to try and talk down the economy, to try and scare them into slowing down. You know, people now, 2 months ago weren't even talking about inflation, weren't even talking about interest rates, and now it is on the tip of everyone's tongues. So by virtue of that discussion and that fear, people generally tend to slow things down when it comes to their discretionary spending. And that's what the central bank governors are doing right now. They're not trying to scare the market into oblivion. They're just saying, hey guys, cool your jets, slow it down, because if you don't, we are going to have to follow through with all of these rate rises in successive fashion. At the end of the day, I'll run through what's going to go on with Australia, but we have seen some surprise reactions. The Swiss National Bank delivering a surprise 50 basis point hike. That was their first in 15 years. And what we're seeing them is they're starting to try and play with their currency in the depegging. And obviously they don't want to see too much of a devaluation in the Swiss franc as all the other central banks start to raise their rates. The Bank of England increased their rates by another 25 basis points and signaled they may have to add another 50 in August. I wouldn't be surprised if we actually see a 75 or 100 basis point rise in the UK given today's numbers. Inflation rates of 9.1% is quite concerning, and they're going to have to try and get ahead of those numbers, bearing in mind central banks are reacting to historical data. The RBA is actually in a worse position because at least in the United States they're getting their inflation numbers on a monthly basis. In Australia we don't get them until 3 months later, so it comes out quarterly. So they have to use other tools in their tool chest to try and anticipate what that number looks like, which may be 3 months out. So running through the Australian economy, well, this is how we look. So as you can see, quite a high number and certainly forecast to go a lot further above. The dip obviously was in 2020 was due to COVID when everything pretty much ground to a halt. But then unfortunately we've seen this massive leap out of that 0% inflation to where we are now. There's been a lot of commentary coming out of the Reserve Bank and market commentators over the last 2 years as to what that inflation is going to look like. But the strange thing is everyone agreed there's going to be some sort of inflation, which you always got to get when you have a large injection of capital coming into the market like we have. So where we're seeing things at the moment, it's not a matter of how we're going to struggle with inflation, it's how high it's going to get and what the Reserve Bank is going to do to manage that. At a briefing on Tuesday this week, we saw a number of comments coming out of Philip Lowe and the Reserve Bank in terms of where they see things going. So in a quick summary, they're expecting inflation to peak around 7% in the December quarter, which is certainly a lot lower than the 9% we're seeing right now in the UK and potentially higher in the US. Following this, by early next year, they're actually expecting that inflation will begin to decline, which I think is quite contentious. I think he's probably counting his chickens a bit too early to make that statement. He's also said he doesn't see a recession on the horizon in Australia, saying the fundamentals are strong in Australia and the position of household sector is strong, and firms are willing to hire people at record rates. Once again, I think he's sort of being a bit adventurous in his use of verbiage there. The housing sector, on average, is strong, but across the board, not everyone's in the same position, and we'll run through that very shortly in the later slides. But yes, firms are willing to hire people at record rates as long as firms have the courage of their conviction to be able to go through and hire if they are comfortable with what they see on the horizon. At the moment, we are coming up to our 30 June period, which for us and for a lot of other companies is our busiest time of year. In July and August, that's when we're going to start to see Australian companies and also US companies reporting their 30 June results. And that, to me, is going to be the critical point, but I won't go into too much detail right now because I'll cover that off in the equity market commentary. So how does the Reserve Bank come to these assumptions? Well, there's a lot of, I guess, inferment or beliefs in terms of why this is going to occur. So I always like to put these things up because it's great to come back in 6 to 12 months later and see whether they're on the money. Gut tells me they're not, but we'll see what happens. So they're assuming that based on those comments, the following three factors occur. Global production systems adjust, helping lessen some of the inflationary pressures. To me, the biggest problem that we've got right now is that global production system was broken before we got into this situation due to COVID. We've had issues with China in terms of shutdowns. We've had issues with supply chains. There's a lot of pieces in the puzzle that are broken at the moment, and I don't think that's going to be fixed in the shorter medium term. I think it's going to take probably greater than 6 to 12 months for the system start to unwind itself, and that's on the assumption that China doesn't go back into a lockdown with a zero COVID policy. If that happens again, then we're back to square one. Inflation is the rate of change of prices. It's not a measure of the level of prices. So what he's saying here is it means that for inflation to stay high, prices have to keep increasing at an elevated rate, which becomes increasingly improbable over time. And of course that makes sense. If you're paying $10 for a lettuce, what they're paying back in Australia right now, obviously that lettuce, according to the RBA's thinking, can't be $20 in 12 months' time. Well, in actual fact, it can if the supply chain issues don't resolve themselves. So obviously the lettuce example was convoluted and made more difficult due to floods with crops being wiped out. But what we're seeing here right now, there's a lot of these mixing issues that are contributing to what we're going through right now. And that's not to say there's more not to come. Obviously a tightening of monetary policy that is underway around the world, including in Australia. So what we're seeing is obviously globally, central banks are grappling with inflation. They are raising rates, all with their own different sorts of commentary, all with their own different rationale in terms of will they go hard early or go slow. Time will tell who plays it right. But at the end of the day, I think Australia's going to try and find itself middle ground when it comes to not being as aggressive as the US Fed, but not being as slow to act as the Bank of England. So where to for interest rates? Well, interbank futures are fully pricing in for a 50 basis point rise in June with a chance of 75 basis points possibly. So for those people out there who've been listening to us on the podcast, you would have heard an episode back in probably May when I said to James that I think we're going to see 3 50s in a row, then a 25. So far I'm right with that first 50. Next month I'm thinking another 50 in August, and then possibly a 25 after that. So essentially what this will do, it will take official cash rates from 0.85%, which is where it was, up to 3.8% by Christmas and around 4.2% early next year. So quite a bit different to what the RBA is looking at and considering. For us, if we can see that slowdown occurring and anticipate that slowdown occurring, then we don't see any further rate rises. But my gut tells me that we're going to see the central banks overcook on rate rises and then look to rate reductions in 2023-24 if they start to see things slow down too quickly. At the end of the day, no one knows. But we do know that based on the numbers coming up right now, we are going to see at least another 3 rate rises in Australia. The big question is how big that will be. I think it's a pretty safe bet to say for at least you can lock in 50 basis points for July. But obviously the market's saying there is a chance of a 75 basis point rise as well too. On to equity markets, and this has been certainly covering a lot of the headlines, and certainly people are watching that if you have super funds, investment accounts and everything. And we'll sort of try and take a bit of the hype out of the conversation. The big thing I think people need to realise as investors, but also too as people sitting on the sideline trying to make a view of the market, is the market as investors relies on a news flow to stay fully informed. Equity markets are very different to the property market in that it will reprice instantaneously based on an event, whereas property, it can take 6, 12, 18, 24 months for it to be priced in. Obviously, at the end of the day, with equity markets, your share price adjusts whether you're selling, whether you're not selling or not. You can be holding those shares, but based on news inflow, it'll adjust quickly, whereas with property, it won't adjust, and it won't really adjust until you go to sell that property. So that's where it does cause a little bit of consternation with investors out there when they see this large volatile swings. We always say to clients, you don't have a ticker tape sitting on the top of your house telling what your house is worth at that particular point in time. You only really know what it's worth until you put it on the market. And whereas equity markets and currency markets, for that matter, you do see it instantaneously. So it can cause a little bit of discomfort when you do see the amount of volatility going through right now. Equity markets do rely on a constant flow of information. So when companies are coming out their results, CEOs are providing forward guidance, investors can price in that news and also price in what the next 12 months looks like. Over the last 2 months, we haven't had any companies reporting their results because they do that early this year and obviously in the middle of the year coming up in the next month. So all investors have really got to go upon is the commentary coming out of the central banks. And the central banks are trying to talk the economies down. So they are painting a pretty bleak picture. And by doing that, investors are taking that as gospel and reacting accordingly. Now, remind yourself, the people providing this commentary, the central bank governors, are the same ones who 6 to 12 months ago, especially 12 months ago, said there will be no rate rises. So they're not infallible, they are not perfect. And what we're going to start to see in the next 30 to 60 days is a bit of coalface intelligence as companies start to report their results. Now, we talk to a wide variety of clients in many different sectors, and I can tell you right now there's not many that are doing it tough, even with these experiences. They certainly find supply chain issues a problem to grapple with, but there's no insolvencies and bankruptcies going on. The only exception to that would be construction companies back in Australia, which are having a hell of a time trying to navigate this period. So share markets have fallen in recent weeks due to worries about inflation, monetary tightening, recession, geopolitical issues, including the invasion of Ukraine. It is still too early to say markets have bottomed. You only really know when the bottom has happened when historically it turns and up we go from there. But we can use a lot of key metrics like PE ratios, price to book ratios that are a value of the share versus how much the company makes. And what we do look at that is we have certain key lines in the sand that we know when a share price falls to a certain level, that regardless of the noise going on out there, that company is good value. So key things for investors to bear in mind as they're navigating this sort of period, sharebacks are healthy and they are normal. There's nothing to worry about that. We've gone through many of these. In fact, last decade, we saw a lot of these go through. People forget very quickly, and my wife reminds me, it's sort of like childbirth. You do forget very quickly how bad it was at the time, and you push on to better times. Share pullbacks provide opportunities for investors to buy more, as long as you're buying the right companies. I'll run through shortly the companies or the sectors you need to consider in terms of what are the right companies and what are the wrong companies. But at the end of the day, as long as you're buying good quality companies that when you look out in the next 12 months and you do factor in higher interest rates and potentially higher inflation, that can survive those periods, then at the moment, over the next couple of months, might be a very good opportunity for you to dip the toe in the water if you're considering that. So shares are still an attractive investment from an investor's point of view based on yield as well too. I'll show you some numbers shortly where it compares the yields of Australian shares versus the cash rates at the moment. While that is still the case, the share market will still be a very attractive option for investors. Where we see the opposite of that occurring was the GFC, when banks were desperate for capital and they were offering 5, 6 and 7% term deposit rates, and that's out for 3 and 5 years. So investors are saying, well, what's the point of putting money in shares when I can get a guaranteed capital return out of a bank on a term deposit? Right now, there's so much competition going on with bank deposits that investments in the equity markets are still very appealing. So is this normal what we're going through? And the answer is 100% yes. the press love to wax lyrical over certain key phrases, bear markets, bull markets, all those sort of things. At the end of the day, the stock market is a market of stocks, not a market of markets. And when I say that, what I mean is you might have a Facebook that's falling 40%, but then on the other side, you might have another company that is doing incredibly well this sort of time. So just because you're invested across the market doesn't mean you're getting the worst or the best. You know, diversification is very important, and it is a normal part of investing when we do go through these peaks and troughs. So certainly while the falls can be painful, they're healthy because what it does, it takes out the excessive risk taking. As we ran into, you know, January and certainly just after the invasion of Ukraine by Russia, the market was a little bit too overheated. You know, there's a lot of cheap cash around because the interest rates were low. People were betting. We had a very strong 2021 calendar year, and people were buoyed on the back of that to try and replicate double-digit rates of return like we saw in the previous calendar year. But what they didn't do is, you know, there's too much leverage in the market. When there's too much leverage in the market, at the first sign of any sort of bump, people who use gearing to invest will pull their money out. So we sort of see the latecomers and then the speculators come and go willy-nilly. So the last decade regularly saw many major pullbacks, and as you can see from this chart here, you know, this is just all these dips that we've gone through, and this is back to 1900. But as you can see, there's all these dips, but the market, when you sort of put into comparison, it is still on that positive path going up. You know, even with some major events like obviously World War II, the Korean War, that stagflation event in the 70s, and obviously the 87 crash. When you do step back and look at this as a big picture, now no one on this call has been investing for 122 years. But when I show you the next chart, it does certainly put things into better, more perspective. So this is the ASX 200 going back to 2011, and obviously the MSCI World Local Currency. So this is essentially the world index converted into Australian dollars. And as you can see there, Australia is well positioned as opposed to the rest of the world. We're down 16% at the moment. The world is down 21%. And obviously a lot of that will be skewed by the United States market and obviously the tech shares as well. Australian returns over the rolling 12-month and 20-year period, you know, negative returns are part of you know, the cycle. But as you can see in that chart, that does look like someone's echocardiogram when they've watched the Socceroos play. You know, generally speaking, you know, we always see a rolling, even at a 10 or 12 or 20-month period, 20-year period, I should say, positive returns. It's just a matter of riding these periods out, and if you feel like it, taking advantage on the downside, like we're seeing right now. I will caveat that question, or caveat that comment too, to say you don't invest for the sake of investing. You need to make sure that what you're exposed to is well positioned and set up for the next 12 to 24 months in the period we're going through right now. So what's driving the sell-off? Well, very strong gains from the March 2020 lows. As we saw coming out of COVID, the central banks flooded the market with capital. So as we call it, the speculative froth had become evident in tech stocks, meme stocks and crypto. And this left all of those types of assets vulnerable. And when we do go through these sort of events, the baby can get thrown out with the bathwater, and that's what we've seen. So you don't have to be a tech stock to be sold down, but the tech stocks have hit it the worst. High and still rising inflation flowing through from pandemic's distortions made worse by Ukraine and the China lockdowns. China is the key question mark that we're looking at right now. But obviously the most speculative assets, they're getting hit the hardest. And when you look at an average basis, you know, even if all the other companies, excluding tech, don't go down, tech has in, say, United States, for example, and the S&P 500 is such a big part of that weighting that the S&P 500 can go down, even though the other non-tech stocks don't go down at all. Obviously, crypto, you know, Bitcoin's down 70% from its high last year, flirting with that $20,000 US mark. You know, now we're starting to see instruments that enable people to short Bitcoin. So that will be interesting to see how that plays out over the next 3 to 6 months, because if we do see a rush in terms of people shorting Bitcoin, then we could see that down to $10,000 and $15,000 per coin. So this is a comparison between the grossed up dividend yields of Australian shares. When we say grossed up, we're including franking credits. So I won't go into too much detail on franking credits on the call. We do have a number of blog articles then on our website, which is atlaswealth.com. But essentially, this is the money you receive in the account plus the tax credits that you can earn on those returns. And as you can see here, certainly shares are paying a lot higher yield than the bank deposits. I will once again put a caveat in here. You do need to be concerned and watch out for yield traps. As company shares fall, you want to have complete conviction that the company has no intention of changing or reducing their dividend payout ratio, because there is a chance that you could buy a share that proposes to, based on historical numbers, pay a 5% yield. But if we do see that company amend down their dividend payout ratio, then that could bring their yields down to 2 or 3%. Or like we see with some companies through the core of the pandemic, they may pause them totally. So don't just buy a share because it's yielding high. You need to consider shares based on their future viability. Big question we're getting from clients right now is, should we switch to bonds? And it's a very simple question, because it's a natural thing. People tend to go between equities and bonds back and forth, as they do between equities and property. Normally the answer would be yes. However, through the pandemic period, we saw a massive increase in the issuance of bonds, and obviously the central banks out there in their bond buying programs, which is another way of saying quantitative easing. The problem we've got right now is now these central banks are trying to unwind their bond positions. And on that chart on the left there, you can see the RBA assets going back from 2014 through till the 2021 period. And this period here, and I'm colorblind, so I'm pretty sure it's grey, but if anyone is not, please feel free to put that in the questions and correct me. But this grey period here, you can see this massive escalation of the amount of bonds that the Reserve Bank is holding. Now, central banks don't like holding these positions for a long period of time, and they've already said worldwide they're going to start unwinding these positions and start selling these bonds into the market. So the question you have to ask is, would you want to go in and buy something when all the central banks are selling them and will be selling them for the foreseeable future? That's why we have seen bond yields rise so high. And in that chart on the right, you can see the percentage of bond holdings with all of the other major central banks: Japan, UK, Eurozone, United States, Canada, Australia, New Zealand, and Sweden. So we've seen this massive escalation that has to unwind. And at the moment, you wouldn't want to be certainly holding corporate bonds. Govies or semi-government bonds are a consideration, but you need to tread very carefully, because there could be a wave of selling, which you still will receive your coupon payment, but the problem is your capital level may be eroded. And there's a bit of a confusion out there amongst investors that think that you can't actually lose capital when you buy and sell bonds. And the answer is you certainly can, just not as extreme as equities. Okay, and on to, do you sit in cash? And that's a big question and a big conversation we're having with a lot of folks at the moment. The answer is you're losing money if you're sitting on cash. So what this here is the real cash rate. So right now we've got the 90-day bank bill rate, which is essentially the official cash rate provided by the RBA. But when you factor in the current inflation levels, as you can see, you're actually down a bit over 3%. If you're leaving money sitting in the bank, you're actually losing 3% of that value every single year. So you do need to consider what you do going forward. If we do see inflation jump to 7%, then you're going to have to be looking at getting a 7% return on your money just to break even. So cash or sitting cash under a bed or in the bank, wherever you fancy, may not be a long-term answer. Certainly short-term, yes. It is good to use cash as a speed brake or as a shock absorber when you're trying to navigate these markets. But as a long-term proposition, if we are going to see inflation staying at high levels for a sustained period, your purchasing power will be eroded away very quickly. So what is on the shopping list going forward for the next 12 months and 24 months? You need to look at companies that perform in rising rate environments. So obviously companies with low gearing, companies with high gearing are going to feel the pain point more. Also consider companies, excluding companies that are very sensitive to discretionary spending. If Mr. and Mrs. Smith are paying more on their mortgage, that means their discretionary spending is going to start to decay. So consumer discretionary stocks will come under more pressure. Consumer staple stocks should be able to ride out those sort of paths. Be wary of banks due to potential of increasing mortgage defaults. Banks have been a mainstay in certainly Australian investors' portfolios for many years. The banks make up 38.5% of the index. At the moment, this is one of the reasons why we personally don't recommend the ETF on the ASX, because almost half of your portfolio will be beholden to the banks. And as you can see on the next chart here, this is what we call the NIM, or the net interest margin. And this is the margin that the banks make their money on. So they'll borrow the money at 1. And as you can see here, the NIM on average across the board is about 2%. So they'll then lend it out to the market at if they're borrowed at 1, they'll lend it out at 3, and they'll make that 2% differential. They haven't come close to being back to the halcyon days of what they were in the early 2000s. You know, the good old days when all you had to hold was the 4 banks, BHP, Rio and Telstra, maybe CSL, and you could make good money. Now banks aren't what they used to be. So now they're relying upon market share rather than margins to make their money. So much so that mortgage applications have fallen off a cliff in the last couple of months in Australia. And I saw the other day that the CBA are offering free internet for 3 years if you applied for a loan through them. So they're now trying to really cope with this reducing margin pressure. There has been a lot of talk out there that rising official cash rates gives the banks the ability to increase their net interest margin, which is true. But we're concerned that the offset for that may actually be rising mortgage defaults, which may sap the firepower there. So it's going to be one at the moment, you know, ourselves included, are very underweight Australian banks. We've seen a lot of research coming out of investment banks domestically and internationally saying that they agree. You know, Australian banks are looking a little bit precarious going into what is a very dicey period for the Australian property market. So where to next? Well, we're in a relatively quiet period for corporate news, so expect the macro factors to dominate for now. Company guidance from CEOs will be the key when they release their 30 June results in July and August. And it's not so much the result they're going to declare, but the guidance they're giving. You know, if the company declares a good result, but that says the next 12 months is tough, then you can expect that company, that share price to undergo weakness. If the companies come out saying, no, we're okay, we've got this, we've learned how to navigate through this period in the last 12 months and we don't see any problems the next 12 months, then you are going to see a lot of support for those sort of companies. So not that I'm saying watch every single ASX release coming out, but certainly there are a number of different avenues you can look at to see which companies are reporting what results. And this is just a great chart that Bloomberg and S&P put out, which I think just, you know, really typifies how investors' approaches to these markets can certainly give you very dramatic differences. And what we're seeing here is a chart based on the probability of negative returns going back from 1929 to present. So if you hold a share for 1 day, there is a 46% chance you'll lose money. If you hold it for 1 month, there's a 38% chance you'll lose money. If you hold it for 1 quarter, so 3 months, there's a 32% chance. 1 year is 25, 3 years 16, 5 years is 10, and 10 years is 6%. So model of the story is if you are a long-term investor, if you are in it for the long run, you're not trying to speculate, you're just going through picking up good quality investments in good markets and playing the long game, then you have a 6% chance of losing all your money. So really timing the market and not timing of the market is the name of the game when it comes to investing. So let's jump onto currency markets. And this is always a great topic to talk about with expats because obviously we're all paid in different currencies and we all want to repatriate funds back to Australia at some point in time. So let's go through and talk about the Australian dollar, where we see different parts of that moving and some key points you guys can take away at home. So the Australian dollar is likely to remain under pressure on fears of central bank tightening interest rates aggressively to combat inflation. What this means is when investors get nervous, they will run to the US dollar. We've seen that happen a couple of times over the last couple of weeks, and we expect that to continue as well too. As we see different commentary coming out from different central banks, don't forget currency holders are also investors at the end of the day. So they're chasing yield. If we see the US Fed increase rates quicker than say the Australian Fed or the Australian Central Bank, Reserve Bank I should say, then you are going to see investors starting to move from Australian dollars into US dollars. That will certainly play a part in the currency. Also too, you know, resource-linked currencies like the Australian dollar and the loonie, the Canadian dollar, they're seen as proxies for global growth and risk in general. So if people are going risk on, they want to take risk, they want to get out there and you know, try and exacerbate or exemplify their returns, they will take Australian dollars. If they are concerned, they will default back to US dollars number one, euro, possibly yen, and other ones like the sterling as well too. As we can see here, commodities in the driving seat. So this is the RBA Index of commodity prices. You know, the interesting point to note is you'll see back in 2010 when we're at a bit above 125 on the scale there, and you remember back then that's when the Australian dollar was at about $1.10 to the US dollar. That was the only reason why the Australian dollar was increasing above parity, was because of the commodities. Now, as you can see here, you know, we're well above that 2010 peak, and people are saying, well, why isn't the Australian dollar at parity or above? And the reason being is risk. Back then in 2010, the Australian market, the Australian economy weathered the GFC very well. We had a very strong commodity boom, and that certainly saved our bacon. At the moment, investors aren't as convinced on the Australian market or in the markets in general. So even though we do have very strong commodity prices, the risk factor is what's holding the Australian dollar back. So as you can see there, we are very much a, you know, instead of the sheep's back, we're on the dump truck back in respect to the Australian economy. When it comes to the different, obviously, components of the commodities, you know, iron ore, coal, and LNG are probably our core exports coming out of Australia. As you can see there, iron ore hasn't exactly changed a lot when you look at you know, going back to the early 2000s. Coal has certainly dropped off. You know, that's been a combination of China banning Australian exports or imports into China. That changed recently, but there is a very big, with ESG considerations, very big shying away of coal exports and coal use going forward. The one core factor that is helping the Australian market is LNG exports, so certainly coming out of the Northwest Shelf and out of the Gladstone region with Santos. Give you guys an idea of just how big a component LNG is. Through the middle of COVID, we're talking about April, May, June, a ship leaving the Northwest Shelf full of laden with LNG for exports to foreign markets had about $10 million worth of commodity value on that ship. Fast forward 2 years, that ship is now worth $200 million. So it's just a massive, massive change in terms of the demand for LNG. And obviously things retool and rebuild again, that's where we're seeing those massive prices. So LNG has certainly picked up the weakness with iron ore. Iron ore to me is a pure hedge bet on China. And as we can see in this next chart, you know, China is still, as an export by destination, our number one export destination. Our biggest concerns with China is how they're going to come out of the lockdown. We actually saw them reducing mortgage rates in the last couple of weeks, and the question is are we going to see any further lockdowns? You know, is China going to wind down their demand for Australian goods? And if that in turn happens, then you are going to see some weakness coming into the commodity prices. And if that happens, then you're going to start to see the Australian dollar start to fall off the back of that as well. So where to for the Australian dollar for here? We see it range bound between 65 and 71 over the next 12 months. The biggest thing we're looking at the moment is what's going to happen with the other foreign markets as well too. You know, what is Australia's appeal from a currency compared to, you know, holding yen or euros or sterling or US dollars. And that'll come back to the investors' demand for appetite for risk, but also to returns on that level as well. So running on to the property markets, and look, you know, I think Blind Freddy could see that the Australian property markets were overreached and overstretched, and that it was due certainly a pullback. The big question we're talking about at the moment is how big is that pullback going to be? Our view on the markets is, once again, averages are dangerous. You know, Sydney and Melbourne are going to react more than Brisbane and Adelaide. Regional town centres, you know, they've got their own little microcosm of catalysts that are causing their own changes. People are, you know, sort of fleeing the cities. There's work changes going on. You know, there's a lot of moving parts to this. So I don't think anyone really knows where the property market's going to go, but the consensus is it's going down. For those people who are long-term holders, you've seen this before, there's nothing to be worried about, and I'll run through some of the comments later on in these slides in terms of what you can do to sort of, you know, make that blow a little less harsh on your cash flow. So financial markets are betting the RBA is going to push the key cash rate to 4% by the end of the year, which is obviously going up from 0.85. The big concern is there's about 1 million mortgage holders out there who've never experienced a rate rise before. I always find it bemusing when I read articles in the Australian papers of people who bought property in December who are surprised that rates are rising so quickly. And essentially what they did was they just read the Reserve Bank Governor's comments saying rates are not going to rise until 2024, and now they're in that position of, whoops, we didn't factor this into our cash flow, how are they going to get through it? The bulk of people out there should be okay, but there is a growing concern among key areas and key demographics of mortgage stress. And it's not the normal mortgage belt sort of people, the battlers, so to speak. There's some people out there in eastern suburbs of Sydney, for example, who may have stretched themselves too far. So to me, we're not going to see any real divisive evidence of this until probably the fourth quarter of this year. And the reason being is as rates rise, people are going to start to default. And then they've got that 90-day period before that default is noted as a bad, poor performing asset. And that's when, you know, we start to see mortgage in possession sales and those sort of things. So we've only really been through one small and one large rate rise in terms of, you know, 35 and 50 basis points taking us to 0.85. But then the next step is 0.25 and 0.5. But then if we do get successive 50s over the next 2 months, that's the big question that's going to come back to these people. You know, can they afford those sort of changes? If we look at the sort of numbers on the average mortgage level of $783,000 for mortgages in New South Wales, if the market is right, if we are going to go to 4% by the end of the year, or even 4.2 early next year, then someone with a $783,000 mortgage is going to have to find $25,000 in income pre-tax just to cope with that increase in repayments. Now, normally you'd say that's not too bad. People have, you know, got a bit of capacity. They've been saving a bit of money. When you combine that with rising rising inflation, people are paying $12 for a lettuce. People are paying $2.50 a litre for petrol in their car. One thing or the other is, you know, we can deal with. Both is the big question. Can more so recent mortgage holders, can they cope with it? Because don't forget, rates really haven't changed since 2010, which is ridiculous. So there's a whole generation of people out there who have only experienced a boom period, and the big question is have they left the equity in their house, or have they redrawn that equity and bought more property? As we see people sort of try and build their property empires. So the big question for us is we're not going to really know what's going on with property. We have seen rates of decline coming in Sydney and Melbourne at the moment, but I think it's still too early to say. We're not going to see the real numbers until the fourth quarter of this year. So from October through to December, that to me is going to be the real litmus test of how the Australian property market's going. It's going to really rely upon wage growth. And we saw, obviously, the Albanese government announced through the Fair Work Commission that a 5% rate increase in wages should be passed through straight away. Philip Lowe came back on that and said we can't sustain that sort of growth because that is going to obviously feed into inflation, which is what we're trying to solve. So Australia's got themselves boxed into a corner at the moment. They need to get wage inflation up to cope with the rising cost of living, but also too, they don't want to feed that with feed the inflation, which is what the central bank is trying to cope with right now. So it's going to be a real and interesting one to see these numbers come through. Do we see that number go from about, say, 2.5 up to 3? As you can see, wages haven't really moved very far at all in the last 5 years. So the big question is going to be is what's that catalyst going to be? Yes, at the end of the day, we're going through a period where there's a record low unemployment, and there are going to be some silly numbers being thrown around to try and convince people to move jobs. But only so many people can do that at one particular point in time. So it's going to be a real question as to how they do cope with that in the next 2 quarters. Okay, so we're just already starting to see private dwelling investments starting to drop off. And the big question is going to be is the new entrants, the new capital coming to the market just going to dry up, and then we're going to see a soft landing in the property market? Or are we going to see a new entrants deferred or deterred from investing in the market and existing people coming out? And that's why I say right now, a bit of a turn across the top is not the not us ringing the bell to say the end is nigh and we're going to see a 30% fall in the market. And there have been people out there calling that. So we don't think it's going to be the case across the board. Certainly we do think there are going to be areas that will feel it more than others. but we're not saying the four horsemen of the apocalypse are coming around the corner just yet. One thing we do like to see is looking at building approvals, and this chart shows that across from both high density housing, detached housing and the market in general, those approvals are dropping quite quickly. So the big question is going to be, and I know there's a lot of people out there saying, oh, new migrants are going to take up supply. The biggest problem we're seeing with building approvals right now is the cost of building. No one can afford it. We've seen some pretty drastic numbers coming out of the building sector with respect to being able to build a house in a commercially realistic price. And we've seen builders and developers going, sort of bust left, right and centre. So, there's a number that came out from the ATO the other day that said out of the total debt that businesses owe the ATO, about 35% of those debts are by building and construction companies. So their cash flows are starting to get pretty tight. When you're talking about a double and a tripling in price of basic materials to build a house, it does make it very difficult to be able to achieve that. So certainly building approvals and obviously new developments, you are going to see that start to slow down because it's becoming more and more difficult to do that at a commercially realistic price. Credit's starting to drop, and as you can see here, actually it was late last year that we started to see owner-occupier housing starting to really come back. Investor housing numbers yet haven't pulled back, but we are going to start to see that occur certainly in the next 3 to 6 months as interest rates start to rise. With investors, it's imperative that cash flow is there to sustain obviously any mortgage repayments, and with rental yields at very low levels, it's going to become a very expensive endeavour to buy a property. You're going to be almost solely reliant on that property generating capital returns because you're going to get very low on the income side. Business credit growth, that's been stimulated by obviously the government out there trying to get money into SMEs and large corporates, but I do expect that credit growth to slow down on the business side as well too. So when we look here, so what can you do if you're a long-term housing player and you've got no intention of selling, you're okay with what we're about to go through? How can you improve your situation? This is a chart that, and all these charts, or most of these charts, we get from the Australian Bureau of Stats. So they're impartial, there's no agendas, there's no sort of innuendos. What we're seeing here on the left-hand side is essentially the reference rate that the banks use, and then we've got new loans versus outstanding loans. And as you can see, there's quite a disparity between the variable rate that banks are offering to new loans as opposed to their existing loans. So we've actually got a division called AUDUSD Mortgages, and one of the things we're very busy with right now is helping clients bridge that gap. If you are paying 0.5% too much on your mortgage rate, we're actually going back for clients, going back to their banks and saying, sharpen your rates, otherwise we're going to go to another bank. And if you think about it, if rates are going to start jumping up at 50 basis point increments, you're going to need that 50 basis points to soften that blow. So if you're, got a good relationship with the bank, pick up the phone to them, tell them to sharpen their rates, because if not, you're going to move to another bank. Certainly on the fixed rate side, we've seen that jump dramatically, and the horse is bolted there, and I'll run through a chart very shortly. So if you do have a mortgage in Australia, first thing you do, contact your bank, get them to sharpen the rates. If they're not going to do that, threaten to go to another bank. There are banks out there that do provide loans for expats. We're doing them on a daily basis. So feel free to reach out to us if you need any assistance in that area. But banks do have capacity to move. That, as I said before, net interest margins at record lows, they can't increase their margins. So the only way they can make more profits and record profits is increase the economies of scale. So they are hungry for new business. And as you can see there on that chart on the left, that just goes to show the gap between existing loans and the new loan rates that they're offering. So when we look at people saying, do we move it to a fixed rate at the moment? And to be honest with you, that horse is bolted. As you can see, it's about October, November last year. That's when banks started dramatically increasing their fixed rate loans. And the reason being is the days of the cheap 0.1% borrowing capacity that the RBA was providing the Australian banks, that got turned off. So now the banks have to go out into the market to borrow the cash in order to be able to fund it on the mortgage side, and the cost of funding has gone up. So that's why we've seen these rates turn dramatically different, going from almost 0% on the fixed rate from a 3-year maturity point of view up to well above 2%, and as existing, and obviously 2% going up to 4%, that horse is bolted there. If you want some statistical examples, historically, you're always better off to actually ride the market out through in a variable capacity. But some people like that peace of mind of having the surety of having a fixed rate locked in for the next couple of years. So it is a personal decision and someone you need to talk to with a professional. But long story short, if you think you can get in now to beat the market, you're actually going to pay quite a premium over the current variable rates to have that peace of mind with the fixed rates. So let's just run through onto the Q&A now, guys. While we're doing this, I'm just going to take a quick drink because my throat is about to close over because I've been talking too much. So now's your time to start putting your questions in, and look forward to actually answering that and give you guys some insight on the side here. Okay, first question from Dean. Question around central banks holding these bonds. Are they really going to be selling these at a capital loss? 100% yes. And the reason being is it's not up to the central bank to make a profit. It's up to the central banks to act as a conduit of capital. So right now, I think I might get the numbers wrong, but they're pretty close to it. So for every $400 billion worth of bonds that the US Fed sells, it is equivalent to either a 0.5 or 1% rate increase. So they need to use the bond selling in the reverse way. They will use the bond buying to try and stimulate the market. They're going to try and slow down the market. So by selling bonds, it is effectively a quasi-interest rate rise. So yes, they are going to sell these things at a loss because they have no business of sitting on their balance sheet. They are not an investor, and they only use these bonds as a mechanism through either quantitative easing or quantitative pricing. So yes, they are going to sell that. Next question from Ronnie. Any tax obligations if investing in the ASX market as an expat? Two answers for this. If you bought shares as an Australian tax resident, then moved overseas, then you need to be aware of what's called deemed disposal. Deemed disposal is you demarcating your tax status on those shares. So as an Australian tax resident, when you accrue those shares, you accrue a capital gains tax liability. When you leave the country in the year of your departure, you then pay the capital gains tax that's accrued up until that point, and then from then on, there is no capital gains tax liability. If you bought those shares as a non-resident, so while you've been overseas, then there is no capital gains tax liability. And what it comes down to is we have two asset classes in Australia. As a non-resident, you have what's called taxable Australian property and non-taxable Australian property. And the best way to think of it is taxable Australian property are assets that you can kick. They're physical. House, apartment, a mining lease, a farm. Non-taxable assets are essentially digital assets. Shares, ETFs, managed funds, crypto. So essentially the Australian government wants you to invest money in Australia, but they don't want you to own any physical. And that's why non-taxable assets do not accrue a capital gains tax liability, whereas taxable assets do. Now, when it comes to holding those assets in a repatriation sense, going back to Australia, in that case, your cost basis starts on the date of your arrival. So if you fly back to Australia, you've held a Australian share portfolio for say 5 years while you're non-resident, you land in the country on the 1st of September, then whatever those shares are worth on that day is what your cost basis is. And from then on, you continue to accrue a capital gains tax liability. So while you're overseas, you don't have a tax liability, but while you're in Australia or pre-Australia, you do. The other one too you need to be aware of is what we call non-resident withholding tax. And this is a tax that is applied to a dividend that you receive as a non-resident. So generally speaking, you will either be paying 15% or 30%, or depending on what country you're located in. If you're located in a country that has a double taxation agreement with Australia, then in that case, you'll be paying 15%. If you reside in a country that does not have a double taxation agreement with Australia, then you'll be paying 30%. The good thing is, though, if you do structure your portfolio correctly, you can use tax credits to offset the non-resident withholding tax. So an example of that is ANZ shares or BHP shares. ANZ shares and BHP shares, they pay dividends that have franking credits attached to those dividends. What that means for you is, let's say, for example, BHP makes $1 billion profit. Now, the company tax rate is 30%. So of that $1 billion, BHP will pass that $300 million across to the ATO by way of company tax, and then from that, then we start to say, you know, they have $700 million left over to pass on to shareholders by way of a dividend. Now, the ATO really can't tax you again on that money because that has already been taxed at 30%. So you get a taxing credit at 30% attached to your dividend, which quite nicely matches off against the non-resident withholding tax. So if you reside in, say, United States or Singapore or the UK, then your rate of tax is 15%, 30% franking credit extinguishes the 15%, but unfortunately you can't claim back any unused franking credits. If you reside in a country that does not have a double taxation with Australia, like Hong Kong, United Arab Emirates or Portugal or any other countries for that matter, then the 30% withholding tax does come off on the non-resident withholding tax. So yeah, so long story short, there is a taxable component on the income side, but if managed correctly, you're okay. On the capital side, then that's not an issue at all. Okay guys, so I'm just going to go through these answers and just quickly check a few more, which they're coming in thick and fast, so give me a second here. Okay, question from Ben. What's the status of the residency rule changes? I was wondering who's going to be the first person to ask this. And just noticed here too that you guys can't see me, so let me just quickly show here. Okay, so I'm not sure if you can see me there on the camera, but not a bad thing anyway. Okay, interesting one. The Labor Party did say when the changes were announced last year that in principle they are in support of the change in terms of updating the tax residency rules. They never said what they agree with, what they don't agree with. They said in principle we agree with a change is required. So where we're at right now, there's a lot of open legislation, what we call phantom legislation, that is sitting out there that the Liberal government did propose last year that was never put through Parliament. So essentially we're back to square one. Now the big question is going to be is, does the Labor Party take the work that the Libs and Treasury have done up until now and just proceed with that? Or do they go back and say, okay, we need to revisit this and we want to apply our own policies and procedures and you know, input into that side of things? So I guess the answer to the question is there's been no update, but it's going to come back to Labor's policy. Are they going to be as aggressive? Are they not going to be as aggressive? As an update, we last month lodged a request for a government petition, a professional government petition through Canberra. We've you have to sort of make an argument as to why you want to put a petition forward. Our argument was the current rules, as recommended by the Board of Taxation, displays an equitable treatment of Australian expats between countries that have DTAs and countries that don't have DTAs. So what that means is if you reside in Singapore, even if you breached under the new rules, you have the tiebreaker clause to fall back on that says you're still a tax resident of Singapore. Whereas if you're in Dubai or Hong Kong, in those countries, if you do breach the 45 days and fail 2 of the 4 factor tests, then you are in resident for tax purposes, even though if you're in Singapore, you wouldn't have been. So we've gone and built a petition that requests a change of the 45 days to 90. We've also requested that a number of exclusions be put in place. In times of war and pandemic, an Australian citizen can return to the country and not be deemed as an Australian tax resident if they breach that 90 days. The second one was people should have an exclusion if they are to return to Australia on business. The third exclusion was people should be able to return to Australia to attend to family members if they're sick or unwell. And the last one, and I haven't seen anyone mention this, but one of the first things that came to my mind was actually kids in boarding school. So if you breach the 45 days and you have a kid in boarding school, well, that's a failure of the family factor test. Even if you don't own property, you fail the family factor test and the right of abode, bang. So that kid is obviously financially dependent under the age of 18, and a lot of people haven't thought of this. And to me, when I read through the initial Board of Taxation report back in 2019, I thought this could actually be quite disastrous for the whole Australian education system if there's no exclusion. So we've got about, I might be forgetting one or two, but unfortunately we now have to wait for Canberra to resit for the petition scrutineering committee to view our petition to see whether it meets the rules, and if it does, then we broadcast it out, and we've got 4 weeks to get as many signatures as possible. So I'd like to think I could rely on everyone on the call today to sign that and share it as well. We need to get some big numbers to get notice. So we're shooting for greater than 10,000 signatures. I think we're pretty confident we'll get it with everyone's support, but we need to get loud and very quickly. So at the moment, Libs themselves don't know when Canberra's going to reset. Could be late July, could be early August. At that point, in that first week, that's when we should find out whether they've approved our petition, and then you're going to see us come out with a bang. So, if you could support us, that'd be fantastic. Okay, just going through the other questions here. Sorry guys, they're coming thick and fast, so just, oh my guys, so I can only do one thing at a time. Okay. Thoughts on gold, silver, commodity stocks as a place to park capital in inflationary environments? Will we see a commodity super cycle? That's from Paul. Normally, yes. Commodities and certainly precious metals are a great place to put your money as a hedge on inflation. And normally we would have seen that run to gold and silver and platinum last year. It didn't, because crypto was made out to be the ultimate hedge against inflation, which has turned out to be the complete opposite. So I think it's sapped out a lot of those investors who would have gone to those sort of commodities to seek refuge during rising inflation environments as a hedge to obviously other markets. At the moment, the rule book's been thrown out and commodity prices haven't changed, precious metal prices haven't changed as much as you think that would, given what we're about to go through right now. So the big question is, are you late to the party when it hasn't moved? And if inflation does settle down, are you going to sell? The issue we say to clients all the time is when you're investing in precious metals, you make money on the way in and not on the way out. So if you buy well, then yeah, you can do it. But you don't get a dividend, you don't get any sort of return or yield as you're holding it. So it is a pure capital play. And if you're going in there, you want to have complete conviction that these prices are going to rise. At the moment, I don't have that conviction. It is in the past 100% during normal markets, yes. But at the moment, this is a very strange environment we're in right now. And we haven't seen the usual 3-step guide to managing inflation because there's so many moving parts in play. Will we see a commodity super cycle? Look, it really comes down to China, and that's the big concern. Technically, when I showed you the commodities index before, we've been in a super cycle, but we haven't seen a lot of that upside only because of the risk factors that people are worried about. A, Australia, it's a developing country, it's not a developed country, statistically speaking, and B, China. What happens with China? Are they going to be able to get their economy fired back up after all these lockdowns and get that going again? So, yeah, it's a tough one. It's a really, when we look at these sort of scenarios, we look at these scenarios from a 12-month, 24-month perspective. And the big question is what's China going to do to try and refire this economy, and can they do it? Okay, next question. Caroline, yep, I answered the question on the residency status. So watch this space. The big thing, we say to all clients is, follow us on all the socials. I'll just change the screen here so I can put that up there for you. So make sure you follow us on that. We are quite active on those social channels in order to communicate very quickly. We like to communicate at scale. We don't hold the information back to ourselves and snicker. We want everyone to share in this information, especially clients, of course. They're usually the first to know, but expats in general, we certainly get the word out there very quickly when we do see a lot of these changes going through the system. But yeah, long story short, it does come back to some key issues that you need to be aware of. Residency, is a very topical one right now. I think we are going to see what we call a mini budget being released by the Labor Party probably around September, October this year. And it's going to be their version of what Scott Morrison announced back in March. So I expect we are going to start to see some sort of announcements regarding the tax residency rules and that's why we want to get this petition out before that occurs, to really try and hit the new government as quickly as possible, because by doing that, fingers crossed, and as we say in the Middle East here, inshallah, we can hopefully try and influence a bit of policy making in the background there with a bit of common sense. Just to explain to folks out there the chronology of this legislation and the timeframes we're looking at. So let's say, for argument's sake, they did do a budget announcement in September, October. They announced, here's the new tax residency rules. It then has to go through an inspection committee in the House of Reps to make sure it's meets the Australian rules from a legislative reasons. Then it has to be voted on by the House of Reps. And now, as you can imagine, there's a lot of policies out there that are being voted on, so it's not like just slots straight in and goes to the first queue. It might take weeks or months before it is fully voted on. And if it does get through that, then it gets passed on to the upper house, the Senate, and they go through the same sort of process. Generally speaking, if we go back and look at how long it took to be sped through, when we saw the main resident exemption, Mark II, that was in 2019. The policies was released in July, explanatory memorandum around July, voted on August, went through in September, and then October, November went through the Senate, and it received royal assent in December the 19th or the 16th. So it can take, in a quick way, 6 months for these things to go through. If we look where we are right now, if Labor does announce that they are going to proceed with these changes, then, bearing in mind Canberra doesn't sit over Christmas, we may not see a push, or even if it's rushed through, we may not see anything until probably, from a Senate point of view, May, June next year. Then it has to get royal assent. So if they really want to rush it through, the earliest this thing can come into place is the 1st of July next year. So look, just keep following on the social channels, because we'll keep you posted along the ways, our ears to the ground on a daily basis. So as soon as we see a sniff, we'll certainly let everyone know. Okay, my pleasure, Ronnie. Thanks, mate. Dean says you can see, that's great. Okay, some people are saying they can see the Q&A slide, but not me. Others, I think it depends on the platform you're working on. If you can't see me, that's not a bad thing. There will be a recording. No doubt you'll see my ugly mug on that too. A question from Ronnie, how the CGE works of investing in US shares as an Aussie expat in the Middle East from a local trading platform. Mate, this is a good question. And a lot of people will look at a Interactive Brokers or a Saxo or a Swissquote account to invest. There's a bit of a sleeping tablet or a smoking gun, I should say, when it comes to investing US shares from the Middle East. And what you need to be wary of is estate planning tax. If you are holding a US domiciled asset and something happens to you, then Uncle Sam and the IRS will take 30% of that balance, and then when your beneficiaries receive the inheritance, they'll only get 70%. So we're actually not a fan of using those accounts or those assets. You can buy investments that give you the same exposure to US markets and US investments through other domiciles, and you can avoid US estate planning tax. So just be wary. I mean, it's always a morbid conversation to have, but unfortunately we do see these things play out from time to time. It's part of our job. People come to us and saying, I've just lost 30% of my balance in my account. What can I do? And unfortunately, it's nothing. So it's always important to seek advice before you set things up, because yes, it's very simple to jump online and set up all these accounts, start buying US domiciled assets. By doing that, you are opening yourselves up to potential of estate planning tax at a rate of 30%. The other key consideration too is what we call non-resident withholding tax out of the US, which is 30% as well. So when you do set up these accounts, you'll do what's called a W8 BEN form. These forms virtually say to the IRS and the platform provider, I'm a non-resident. Any dividends that come my way out of these accounts, you need to take away 30% of those tax on those dividends. So the problem with that is obviously, you're getting quite a hefty tax, especially when you're living in the Middle East. So that's one of the reasons why we do prefer to use a Australian domiciled account, and we can use franking credits to offset those benefits there. Okay, question from Demin. I'm looking to buy a property in Sydney through a mortgage using my expat income. What will be the best time to finalise a deal? I was in the view probably next January, February will be probably bottom of the housing price. I know what's your best guess? On the contrary, interest rates might be at a peak at that point, and my plan is to secure a variable rate mortgage and later, when the rates soften, then renegotiate. Any advice on this? Can Atlas Wealth Management help me securing a loan? I'm in Dubai for 10 years and Australian PR. A lot to consider there, but to me, it's going to be an evolving piece. You know, if we see rates rise really quickly, then you are going to see more blood in the fourth quarter and the first quarter of next year on the streets in the property market. If by virtue of the conversation that the central banks are having with the market, it manages to slow them down, they haven't got to raise rates as quickly, then we may not see as much carnage. The big question is going to be is how many people out there are, you know, staying too close to the wind. And for those people who do listen to our podcast, and I'll do a shout out for that, Expat Chat. If you just type in Expat Chat into your favourite podcast channel, make sure you follow us. We do an episode every week, coming out Thursdays and Fridays. So, you know, we do talk of these scenarios quite a fair bit. And there's a great saying is, you don't know who's swimming naked until the tide goes out. And that's what we're going to see with the Australian property market over the next 6 to 12 months. You know, the government is a good aggregator of data, but when it comes to how Mr. and Mrs. Smith are living their daily life, and are they living paycheck to paycheck, or do they have money put aside? We don't really know until we go through these sort of events. We can war game and hypothesize as to what's going to happen, but until we're actually going through the day-to-day machinations of rising mortgage rate repayments, rising petrol prices, rising price of lettuce and limes and avocados and all that sort of stuff, until we see that really play out, we don't know what the net result's going to be. So it's something we're saying to clients right now, you know, watch this space, because, you know, like I said, property is a lagging indicator when it comes to price adjustments. Equities and currency, they'll, you know, adjust immediately, whereas property is a lagging respondent. So people will hang on for 90 days not paying mortgage repayments before the bank takes mortgage in possession. Hopefully people don't wait for that to happen. They sell before then, you know, and take control. But the big question is going to be is, do we get that compounding effect going through? So, yeah, so I guess to answer your question, you know, January and February next year will be an interesting time. You know, you're going to know a lot more than we're doing right now in terms of how bad or how good it's going to be. You know, there are people out there and respected, you know, researchers calling for a 30% fall. I don't think it'll be 30% across the board, but do I think in particular subsectors or sub-markets? Yeah, I do. You know, there's some stupid prices out there that people have been paying. And, you know, I was having a chat to a client the other day, and I was talking about a $3 million mortgage. And I said to them, you know, 12 months ago, would you ever consider a $3 million mortgage? I said, not in your life. But it is what everyone has been, you know, sort of conditioned to with that race and that what we call the FOMO, fear of missing out. Everyone's willing to borrow more just to get in because they're worried they're not going to get in. But what it's led to people doing is probably gearing higher than they should do. So I guess to answer your question, Devin, yeah, January and February, you know, you're going to know a lot more than you do now. Can we help you? 100%. You know, Jeremy, who heads up our mortgage division, he'll actually be over in Dubai in September. So we'll be running a few seminars through the Middle East during that period, and you know, you'll certainly be able to have a chat to him and talk through your operations. There has been a bit of a change in the dynamic of Australian banks in terms of who they're lending. Kudos was obviously a very popular lender. They recently got wrapped on the knuckles by APRA, saying that they're lending too much money to expats. So there are other providers out there that we're able to use, and you know, certainly I'll just flick over the page here. Yeah, if you do have any questions, you know, just jump on the website atlaswealth.com. Go to the contact us page, indicate you want some information regarding a mortgage, and Jeremy can organise a time to have a complimentary chat with you. Okay, another question from Ronnie. Mate, thanks for the questions, it's great. Would the new expat tax drafts come into legislation next year? If they pushed it, possibly. We just don't know. You know, we don't know whether Labor's going to have their act into gear to push something through so quickly. They do have control of the lower house, which will certainly help them. They don't need to rely too much on crossbenchers and stuff to make up a government. So if they really, really, really wanted to, then yes, but they're going to have a big job ahead of them in order to do that. And even then, you know, it wouldn't come in until 1 July 2023. So yeah, it's possible, but we'll know more in the coming months, that's for sure. Question from Paul. Please indicate where we can find your petition for signing. Mate, haven't got it yet. So what we need Parliament to approve our petition, because it's one thing to do sort of a change.org thing. We've tried that. We really pushed on that when we had the MRE changes back in 2019-20. The good thing about doing a government petition is that a parliamentarian has to respond who's responsible for the portfolio you're questioning. So by going through this rigmarole of setting something up, if it's approved, and I can't see any reason why it shouldn't be approved, if it's approved, what it means is we have to get a response from the Treasurer or the Assistant Treasurer who's in charge of this portfolio. So once Parliament resumes sitting, which could be late July, early August, in that first or second week, the Petitions Committee should either approve or disapprove of our petition. As soon as I have that email, I can guarantee we'll have an email going out to the world getting people to sign that up. So if you follow us on the social media channels, also too, if you go to AUDUSwealth.com, you can actually tick the box to get notifications, and you'll get that notification as well too. So we will let everyone know, I promise. If you're on this call, you'll be getting an email. Questions from Sharon. Does it apply to crypto as well? In terms of capital gains tax, I'm assuming the answer is no. So sorry, capital gains tax doesn't apply to crypto because it is a digital asset like shares, ETFs, managed funds. It's not a physical asset. So once you're in Australia, yes, you continue to accrue a capital gains liability. If you're a non-resident buying crypto as a digital asset, it's non-taxable, therefore there's no capital gains accrual on that. Thanks, Adrian. Appreciate the kind words, mate. Paul, followed, and thanks for your time. Pleasure, mate. Question from Mark. If they don't change the residency law before the 30th of June 2023, will that push the implementation back to July 24? Yes. Very rarely do we see a change in legislation that occurs mid-tax year. I've actually, now that I think about it, I don't think I've ever seen one occur mid-tax year. And the reason being is it's very hard to manage which part of the tax year, which one applies. So normally if there's a change, they'll announce it, in this current financial year that will come into place in the next financial year. If they can't get their act together, if they're too busy running around trying to find where the toilets are in Parliament House and everything, and there's a lot going on, then trying to get their things under the desks and read up on the polished documents and get their heads around what's going on, then there's a very real chance that we may not see the legislation until post 1 July 2023, when in that case it may not come into 2024. The big question mark, and for those who've been on the calls in the past with us, you'd know that in the Border Taxation's 2019 report, they did discuss an implementation period of 12 to 24 months. So there is a chance that as part of the policy announcement, they may say, here's the new rules, and they're not going to come in for another 2 years. We just don't know. Whether Labor says, well, you've known since 2021, which is when the Libs announced it, you've had your 2 years and it's coming in next year, or whether it's, here's the new policy, but it's not going to come in for 2 years after that. There was talk about grandfathering and all sorts of scenarios as well too. So really, there's a lot of unknowns, unfortunately, that really have left us hanging, and we're certainly desperate to find out which way they're going to lean in terms of more aggressive, more lenient. Historically speaking, Labor Party's been pretty friendly towards expats when it comes to policy changes, so let's just hope that plays out this time as well too. Question from Sharon, what about purchasing crypto on US-based exchanges? Any issues in the same way as buying shares on platforms like Interactive Brokers? I will actually defer to answer this one there, Sharon, because we've got to be careful with our licensing. Crypto is not a regulated product. So we can talk about concepts in Australia, and we understand that very well when it comes to how crypto and crypto exchanges work with US exchanges. To be honest with you, I don't think they've even got an answer for that yet. The laws are still evolving so very quickly. So I probably couldn't give an answer whether the estate planning laws apply to crypto being held in the US exchange, I'm afraid. Question from Rick. Is there any chance with the proposed residency rules, if they somehow got them passed, they could be applied retrospectively backwards? If it was Scott Morrison and Josh Frydenberg, maybe. We saw the shenanigans and pardon the French, the bullshit they pulled with the main residence exemption, saying that we had we've had notice since 2017, which is when they announced it in their budget, even though there's no legislation for us to work from. Look, I would say 10% chance yes, 90% chance no. It'll be incredibly arrogant of them, especially given the intent of the law changes. It's to provide more transparency. It could be very easily argued that it's retrospective if it was put back in time, I guess you could say. So I would never say never. The old saying about how do you know when a politician's lying, the lips are moving. In this case, possibly. But I give it a very, very slim chance. Not even 10%, maybe a 5% chance. I don't think they would do it. Anytime we see a change in legislative action, it's always forward-looking. If something happens, now, it's going to be in the next financial year. Usually kicks off on the 1st of July. Question from Martin. Martin, is there a difference in investing money in managed funds when the stock market is down versus when the market is high? It depends on the managed funds or the ETFs or the individual shares. You can take a broad S&P 500, which has a high component of tech, which the reason for that is because S&P 500 is the top 500 companies, and what are the biggest 500 companies? Facebook, Alphabet, Tesla, those sort of companies. What we find with our portfolio construction is we like to try and moderate the pointy end of the stick, I guess you could say, in certain sectors, which is one of the reasons we don't buy the ASX 200 ETF. We don't want to have 38.5% of our ASX exposure to the big banks, which if they're performing well, which is great, but as we saw before, not the forecast looks a bit dicey for them going forward. So in terms of going forward on the on that side, Martin, look, it really depends on what the makeup of that managed fund or ETF is. If you are looking at buying in an aggregate sense rather than buying individual companies like Facebook or GE or ANZ or Telstra, you can find ones that exclude certain sectors. No, they are out there, but it really depends on if you're not trying to guess the market, if you just want to get broad market access, make sure that the sectors in that managed fund or that ETF don't comprise of more than, say, 10 or 15 or maybe at the most 20%. You don't want to have greater than a fifth of your portfolio in one particular sector, if there are any questions about that sector as well too. Okay, question for Ben. Thanks for your time, a great insight. My pleasure, mate. Question from Paul. Please give a breakdown of the sort of financial products you offer and sell, managed funds, retirement plans. Look, our job at Atlas is we're what's called a fee-for-service firm, which means we don't accept commissions. We are paid by one person, that's the client. People engage us to provide financial advice. That advice is delivered through what's called a statement of advice, which in layman's terms is like a financial plan. The recommendations in there will be strategic, product execution and so forth, but the recommendations in that document will not be swayed by any commissions because, once again, we're only paid by one person, that's the client. Our job is to provide what's called two-dimensional advice. And that means where you are located, where your assets are. By and large, most of our clients accrue assets in Australia because that's the country they intend to return to or retire to at some point. And our job is to provide that tax-optimised advice between how do you make the most of your time overseas, how do you manage assets back in Australia, and joining the dots between those two. We cover off on all major asset classes when it comes to the advice side. To us, a diversified portfolio includes all the major asset classes. So when it comes to managing super, we help clients do that. Managing investment accounts, we help clients do that. Obviously, guidance and advice regarding their property portfolios with respect to tax implications and concessional contribution strategies, we can talk about that. So essentially, if it's inside Australian territorial waters as an asset, that's where we help clients, pretty much help them make the most of their time overseas and make sure they've got something to show for their time away. So, all of our advisors are all degree qualified, and we're not talking Mickey Mouse degrees. Everyone's got a BCom, an accounting, a financial planning degree. So we are specialists in this area. We know what we're talking about. All we do is live and breathe this stuff. But, we always say to clients, and prospects as well, and people who are interested in working with us, jump on a call with us. We have quick 25, 30-minute calls with folks. just to learn more about the problems you're trying to solve, we will tell you straight away if we can't be of assistance. I had a call today with a gentleman in Indonesia. Gave him some guidance, but we couldn't help him with what he had planned. So we're happy to do that. We don't charge for that. Essentially, from our point of view, we really just want to be of assistance and help you triage your priorities and your problems. And if we can do that in a compliant way, then that's what we're all about. Okay. Any other questions there, guys? If not, I'll start to wrap it up. So, as I said, if you want to keep, there's a lot of moving parts going through over the next 6 to 12 months. So make sure you do follow us on these social channels as well. We find it's a very quick and easy way to disseminate information at scale. As I said, it never ceases to amaze me where we find Australian expats located. They really are in the four corners of the world these days. And if you do have any questions, you want to have a complimentary chat, jump on a call with us, to find out more, see how we can help. AUDUSwealth.com. We haven't met anyone yet we haven't been able to help in terms of people come to us and say, oh, my situation is quite complicated. We live for complicated. That's what we do on a daily basis. As one client said the other day, we're the sort of the special forces of the financial planning and tax advice world, because we're happy to provide advice where others aren't. So the more confusing, the more convoluted, the more technical, we live for that. So I see Lisa's jumped back in now. So g'day, Lisa. Hope I didn't bore you too much there.
No, it's fantastic. It's honestly, it's such great information. And for those that are still on the call, and even if people, friends of yours that registered that couldn't actually make the call in the end, all the presentation slides, recordings will be sent out by Brett. Thank you so much, Brett. As always, you make the most complex figures and statistics somehow easy to understand and logical, which is a miracle. I'm not quite sure how you manage it. But thank you very much for your time. We really, really appreciate it. And as Brett said, he's always available. He's the most approachable person that, we work with. So, yeah.
I don't bite.
So thanks very much for everyone for jumping on, and thanks, Brett, again for your time. And go rest your voice now.
Thank you very much. I'll take a big glass of water right now.
Thanks, everyone.
Thanks, guys. Take care.
Bye.